Hi guys, welcome to the next edition of the FINtastic Talks. And today is a very, very special edition because we have a very, very special guest with us today. And it is also the last of the second season of the FINtastic Talks. And we'll be moving forward with the next edition of the FINtastic Talks, which will start in September. But we are very pleased to have Dr. Deepak Mohanty with us today, who is one of the most powerful figures in the Indian financial services ecosystem. He is the chairperson of PFRDA. And thank you, sir, for taking out this giving us this opportunity to being able to interview you. And let me just tell everyone that NPS is probably the most investor-friendly and the most amazing product that has ever been made available in India. And today we'll be deciphering that product. So a lot of us are not, a lot of us are using this product. A lot of us are not utilizing this product fully. But this product offers a great opportunity for all investors to create wealth for their retirement, to build that dream of a second income. As I explained, second income is a day where you have enough income that you don't need to work if you don't want to. Or if there is a situation like a lockdown where for a lot of people their income stopped, then you must have an income which is able to support the kind of lifestyle you want to live. And this is where a national pension system or a pension scheme comes into it. So Dr. Mohanty, welcome. Thank you for being with us on the talk today.
Thank you, Sanjiv, for having me in the show. And I thank all your viewers and those who are connecting. I'm happy to be in your show. Thank you.
So, sir, let me start by you're probably one of the most, important figures, who's played a huge, part in your work with RBI on Indian economy. So let me just start by asking you about the Indian economy. What do you feel about it? Our Prime Minister made a commitment that in his third term, we are going to be the third largest economy in the world. And, we as investors see that as huge wealth creation opportunity. So just, given that your huge expertise with the RBI and your understanding of economy, where does the Indian economy stand? Just tell us a little bit about that.
Sanjiv, I would think that Indian economy is in an inflection point. Of course, there are several challenges. But many things are going our way, and historically, one finds this occasion once in a generation or a couple of generations, because on the face of this planet, we are the largest country, most populous country, and it's a young country. In terms of economic performance, if I would have to just sum it up in terms of the per capita income, so we are in the range of 2,600 to 3,000 per capita income. I'm saying in US dollar terms, which would place us in a lower middle income country. And as we usher into Amrit Kal and aspire, as you said, that to become an advanced country, so why not? So at least we'll become a very high income country, upper middle income country, which is going by the definition is about 4,500 per capita. I think the lower band going up to 12,000 per capita, and crossing that would be in a high income advanced country. That itself would unleash a lot of potential. In terms of the financial capability of people and affordability for many things, for example, like pension, that people don't look at that. The other thing also would be that we really would have to see the structure or market, how it is, and that if you see the labor market, mostly then we are in the informal, unorganized sector, because if you see the organized sector, which is about 10% of the workforce, and 90% is in the unorganized sector. Organized sector, so there is some statutory access to some kind of a retirement, post-retirement benefits, which is there. But for the 90%, it is not. So then we really would have to provide for it. And unpleasant truth, the young population in due course going to age, and the time to make provision for that period is now, because if you start young, then we can have a good retirement corpus, and our post working life could be much more better for us.
Thank you, sir, for giving a very good background on the purpose of national pension system. So, as you know, I like to say this is probably the most powerful investment opportunity for Indian investors, and but a lot of people don't know about it. So, if he can just explain to people, and I'm sure they're, although the people who watch these talks are all investors, and we keep talking about NPS. So, just for the people who are probably don't understand what national pension system is, you know, one, it is taken as that okay, this is the way the government pensions are now being paid. But for a private sector individual, what does NPS mean? What are you trying to achieve there? What is it all about? If you can tell our viewers, that will be amazing.
It is a defined contribution pension plan that we provide for it, and people have to provide for it. Employer, employee, both are there. They really would have to provide for it. And this came, the genesis of the whole thing, as you know, from the government pension system, which one would say that pay as you go, that the pension was given from the general revenue, which is not a sustainable proposition. That is how it came in 2004. Now the same system has been extended to individual, to a common person. You don't have to be employed to take benefit of that pension system. And then in 2011 to the corporate. So everybody is on board. So earlier, somebody who is a pensioner, it was distinguished like somebody in the government, so has a privileged access to pension. But now that's not the case. Anybody can really have an access to NPS. So it's a defined contribution plan. People can put money, and then they get it gets accumulated, and they get the benefit of pension in their post retirement year. For example, suppose the retirement year is 60 years. So post 60, one can get at least 40%. One can annuitize in the process, that you get a monthly income coming out of that. That's the minimum. 61 can withdraw and use in different ways, and this is invested in the market, of course, regulated by us, the pension regulator, and giving very good returns. And depending on one's risk and what stage of life one is in, so there is also asset choice. For example, somebody is younger, it makes sense to go in for equity. For example, somebody had that kind of a risk tolerance, which is here that in the scheme, active choice, one can go for full equity, meaning 75% can be invested in equity. Somebody cannot decide, I don't know what should I be doing, because these are financial choices. Then we have a kind of auto scheme. We say that your life cycle scheme, LC50, 50% gets invested in equity, and as the age one progresses, because equity cycles, as you know, is longer. So as the age progresses, the equity component comes down. So we have different options. Somebody completely risk averse, for example, can go for the 100% GSEC scheme, government securities. So all these facilities are there. In that process, in the market process, the corpus gets accumulated, and there are returns are pretty good and comparable to the benchmarks in the market. If I may just give you as an example, since inception, the equity schemes have given on an average annual return of over 12.6%. Short term, if you see, of course, the market is doing well, so the returns are quite good. And pure GSEC scheme, that since inception, it is given a return of 8.7%. So these are quite good returns. And so with that, I think the accumulation of retirement corpus could be quite significant.
Yeah. So, earlier I think this can be a path-breaking scheme because, earlier we were stuck to doing pension meant only debt. And, debt you're restricted to that 6-7%. And all of us have heard the power of compounding and the rule of 72. That look, if you get a 6% return, then with the rule of 72, it will take you 12 years to double your money. Whereas if you get 12%, then your money doubles in 6 years. And if you get 24%, it doubles in 3 years. And with the power of compounding, it keeps growing, increasing. So today, as you said, India's economy is in an amazing space. It is the most populous country. It is a country with the very right, age profile, and there is a huge amount of growth, and there is a huge push from the government to make India a great manufacturing economy in addition to the services economy it is. So we are in a great place. So, sir, also that there are a lot of people who invest in direct mutual funds, and they believe that it's a great saving they are getting. Let me just tell you that pension schemes, which are the same like a mutual fund only, they're exactly the same, and they are almost 85 to 90% cheaper than even a direct fund. So what you're paying for managing a direct fund, that option is there. So, sir, there is a lot of questions about tier 1 and tier 2. So if you can explain to our viewers what's the difference between tier 1 pension and tier 2 pension schemes, and how can investors use tier 2 as a pure play investment choice instead of a mutual fund, a direct scheme?
Sanjiv, you said it, the power of compounding, the kind of global survey that we see, even including advanced countries. 2/3 of people don't understand the difference between a simple and compound interest rate. That's the level of, financial literacy. Because with a compounding, the growth becomes non-linear. That's what is important, as you rightly said. So it is at a younger age, one should really start. We squirrel away little amounts and all that adds up to a huge corpus. But as you know that when one is young, the retirement and pension is far for one's mind. Nobody wants to have gray hair and get old. But then we are missing out on the bus on the compounding side. Your other question, that tier 1, tier 2, one concern comes, people say that, oh, I put money in pension so that I get logged in for a longer period of time. So what we have done, that you get logged in tier 1 account, which is a pension account. With that, one can really have a tier 2 account. So where there is no lock-in, one can sweep in money into it, sweep out money into it. I said active choice on the equity. That if you are on the tier 1, it is 75% all through your lifespan, as long as you are continuing on that choice. In tier 2, if you go for equity, it is 100% equity. You can use it as a liquid funds. Then you can take a call on the market. You can invest on that side, and there is absolutely no limit how much of money could it be put, when the money could be put, and when it could be taken away. So both combined together. So that also gives the liquidity and also some long-term corpus.
So I think very well explained. In fact, one of our viewers has asked this question also, that money gets locked in. So this is Mr. Rakesh Rawat. So Rakesh has, explained to you, there are 2 tiers of pension scheme. One is a tier 1 pension scheme where money does get locked in. And the reason you have a lock-in is that the purpose of that scheme is to help you save for your retirement. And retirement doesn't have to be 60. It can be, you can choose your retirement age. It can be 50, 55, 60, depending on the organization that you're working or even, and right now you have an option also to defer it. Like, a lot of people choose not to retire at 60, and I'll have sir explain that. That's one of the most amazing options that has been brought in, that where you can defer it. But there is also a tier 2. Average fund management charges of NPS is 0.04. And as sir said, that you can invest in a pure equity So there is no difference between that and a mutual fund. A direct mutual fund, you will pay 0.6, 0.7% to manage. Here, you will pay 0.04% to have that money managed. So you are making that saving of that 0.55 basis points. So that's a simple thing. And tier one, the reason they are lock-ins is one that so social security will only be achieved if you keep your money, and also there are a lot of tax benefits. So, sir, if you can explain to our viewers a little bit about the tax benefits available for NPS tier one, that will be great. I think we are facing some technical issue. So, in the meanwhile, let me talk about the tax benefits. So, one is that for an individual investor, there is a separate 50,000 rupees tax exemptions available for investing in NPS scheme. The reason government has done it today, NPS is the only place where exclusive uh, benefit has been given for tax saving. So that even so if you're a 30% taxpayer, then you're actually saving 15,000 rupees on day one. So your 35,000 rupees becomes 50,000, and then you're getting a mutual fund return. As sir had explained, the average return of an NPS equity fund has been over 12%, which is in line with all the equity, all the leading equity funds, and it's the same fund managers, same type of fund managers who are managing that money. And also there is a second option, which is a corporate pension scheme, where your employer decides to pay 10% of your basic salary into NPS. Then that 10% paid doesn't get added to your income up to 7.5 lakh rupees. Earlier, this cap wasn't there. Today, it has been capped at 7.5 lakhs, including the employer's contribution of EPF. So this amount of money again becomes tax-free. So let me take a very simple example. A person with a 75,000 rupee basic can contribute up to 7,500 rupees per month into NPS, and that will be purely tax-free. But it has to be done from the corporate. So you cannot opt for the corporate scheme on your own, but you will have to get your company to register for the corporate NPS, and they'll deduct that amount and pay it for your pension. See, the purpose of this is that earlier pension, was the only domain of the public sector employees. And when we were young, and I'm sure a lot of you also used to hear about, okay, he's joined a government job because it is pensionable. He's going to get a pension post his retirement. But today that pension can be available to a self-entrepreneur also. It can be available to a small business owner, and it can be available to a private sector employee also. So similarly, even in government sector today, people are contributing towards their own pension. And similarly here, we are contributing towards our own pension, and with being able to invest in market-linked instruments, we are able to build a great corpus, and that corpus can give us a lot of can give us a great life. Today, all of you must look at systematic withdrawal plan options, and now they have been launched through NPS also. That can make your money last much longer and give you the kind of desired income you want. As sir had shared, 60% of the corpus can be withdrawn without any tax as a lump sum, which you can go buy a mutual fund at that time, a systematic withdrawal plan. 40% has to be, you have to buy an annuity plan, which gets added to your income. So that treated like your income. So that can be taxable provided you are in a tax bracket at that time, or it may be tax-free if you are not a taxpayer at that time. So I hope I've been able to explain that. And we are facing some technical issue with Dr. Mohanty, and I hope he can join back soon. On Vipin Paliwal has asked this question: what is the taxation in tier 2 if we withdraw at any point of time? So Vipin, it is taxation of tier 2 is equivalent to a taxation of a mutual fund. Okay, so the rules are very, very similar, and it is managed in the in a similar manner. And so, guys, in the meanwhile, while we are waiting for Dr. Mohanty, if you have anybody has any questions, please do write in comments, and we are able to see them, and we would love to answer that. We'll love to answer those questions. So I guess guys, there's a question that only 60% of the amount is withdrawable. I've been able to explain that it is not 60% of the amount is withdrawable. 60% of the amount is withdrawable as a lump sum. Okay, remaining 40% is also withdrawable, but you have to buy an annuity scheme. Annuity scheme is a scheme which gives you a regular income, and you can choose the kind of period you want. So annuity schemes are typically available for 10-year plus, and they also have an option of return of corpus. So at the completion of the annuity scheme, you get your corpus back, or you can buy life annuity, and where the corpus gets returned, after your death to your children. So Tanya has asked that how is PFRDA collaborating with other financial regulators? So, I think this is a right question for Dr. Mohanty. So I will let him answer that.
Yeah, sorry, my apologies, Sanjiv. Then the internet went up suddenly, and we have regulatory interaction. We are part of the Financial Stability Development Council, where all the regulators are represented. So apart from that, we have our also informal channels that connecting with the regulator. And if you see, for example, that there are different intermediaries that we regulate. To give an example, a point of presence would mean a bank, which also offers an NPS. To the extent they do the NPS business, they are regulated by us. But the principal regulator again becomes the Reserve Bank of India. So we don't want to duplicate the regulation. Certain things, for example, on cybersecurity, if they're compliant with the RBI's requirement, so that's good enough unless we have some additional requirement coming in from that side. So obviously that would mean that kind of regulatory collaboration. So that's what happens. And of course, if you see the pension funds which manage this corpus, currently as you speak, we are just shy of 10 lakh crore pension assets which are being managed. Obviously, they're invested in the financial market, and depending on the instrument characteristics, one has to go by the rules of the game. So this is how it is coming. And in terms of operation, if there is an ambiguity in terms of various regulations which apply across different regulators, we try also to sort it out in that sense.
Thank you, sir. I think that was a very, very clear and crisp answer. And if you don't mind, I'll take another question which is very similar to this, since we have started. So how does PFRDA monitor? This is by one of our viewers, Suraj Sahu. How does PFRDA manage and regulate pension funds? Now, this is a question that, since a lot of people don't know about NPS and pension funds, this is a question where you and me know the answer. But for our viewers, if you can just explain to them that, how do these work?
See, regulation one would be, for example, if you have to give investment, there are investment guidelines that we have put out, that what they can do, what they cannot do. For example, if I could mention that on the equity market, it is only top 200 scripts they can really invest as things stand now. So it is not cast in stone. Periodically you review depending on the requirement. For example, that if you go for debt, corporate debt, it is mostly AAA rated company, AAA to AA. So that's how it is. So because these are pension corpus, So we are also conscious about safety. Despite these requirement, suppose a particular instrument doesn't perform, so they have to fully provide for it. If it is NPA, that is fully provided for. The other thing is the market discipline. The net asset value, the resultant of this valuation, the net asset value is declared on a daily basis. So actually, what you actually see, you get that. Sometimes people get worried that the net asset value is coming down, because since these are also long-term fund, actually the loss has not really crystallized, because if the interest rate changes, so interest rate goes up, you see that your net asset value comes down. But we don't hide that. It is purely marked to market. So you see it. So there is a lot of hidden value in the system. Those who understand, they understand that you stay on for a while, it will come back up again. So that is how it is done. So then, of course, there are 10 pension funds which manage your funds. And here, the other thing is that the investor has the choice. You can choose a pension fund. You don't like that particular pension fund, you can change it, a couple of times during the year. If the market is moving in a particular way, you can change the composition of instruments. All that at the fingertip of the investor. So that is there. So that apart, these 10 pension funds which are there, so they're under our regulatory and supervisory purview. So we have off-site monitoring their performance, and we have also on-site verification on that basis. And we also do a quarterly meeting with them to see how the funds are performing and what is their strategy going forward. And since these are the investors' money, we see that these are the things run at the best interest of the investor, because the investor is the king. So we try to see that maximum benefit accrues to the investors with reasonable safety of the funds.
So I think very well explained, sir. So guys, for the viewers, typically understand pension funds are like a large cap fund. So they may have equity, but they play on the safer side. So today in pension funds, the fund managers who are similar, like you have HDFC fund manager, SBI, LIC, Kotak Mahindra, and others. So they can only choose amongst the top 200 equities. That has been done so that the corpus is in the larger companies, and there is lesser variability and more safety towards that. Sir, you talked about NPA, that if there is an NPA, they have to provide a guarantee. Even I wasn't aware of that. What exactly is that provision?
I'll not name companies, because sometimes you see that a AAA company defaults.
Yeah.
So then, that particular portion of your bond portfolio has become non-performing, because that bond is not being serviced. So they have to completely provide for that, assuming that in the portfolio it was 10 crore. So they would have to upfront provide, if it is not serviced, that 10 crore. Suppose
so
that
this has to be provided by the fund manager.
By the fund manager, yeah, from the kitty. So that is, the losses are not carried on the books. So assuming that it goes through the different processes and there is a recovery, then you can always write back the recovery which has come. But not waiting for that upfront, it has to be 100% provided for.
Wow, sir,
So
this is an amazing. Even I wasn't aware of this. I think this is worth its weight in gold. So those of us who are asking that how does it compare, I think no other instrument has this kind of safety other than some life insurance schemes where there is a guarantee and where this type of safety is available. But this is excellent. Sir, also we have a viewer called Vipin Paliwal who's asking about the taxation of Tier 2. Now, a lot of people don't understand the taxation structure of Tier 2. If you can just explain it to them.
Mr. Paliwal, I would think that, what you are investing in Tier 2, obviously it is post-tax, your income which is coming on that. And the gain which is coming out of it, because that's what money that you have put, so that is also expanding. So this should be at your level of income, that is the which bracket really you fall. So that is how it should be. And Of course, there's not so much of clarity whether it should be done as a capital gains or it should be done as at the income level. But as things stand now, it is more at your level of income bracket.
Okay, so
The
sir,
gain,
but I
only the gain which is coming out of it as long as you're holding it.
okay, so I thought there was a clarity that had been brought that it will be taxed in par with like a mutual fund on a long-term capital gain. So right now that clarity is not there. So the gain gets added to your income.
Yeah, that's what I would think. So
Then that's super. So another very exciting question, and this is something that a lot of people have been waiting for. One of our viewers, Mr. Anil Chopra, is asking this question that we are waiting for an announcement on SWP on NPS. By when can we expect the guidelines? So this is, sir, if you can just explain to our viewers the SWP concept. I think it's a fantastic concept that is being brought in. And, what is the status of the guidelines on this?
yes, Sanjiv, I think two things. Earlier, you also mentioned that we can really really can choose one's retirement age. The longevity is also increasing because there is always an endpoint risk. Suppose one is put in the equity that when the date, the clock ticks that your retirement date, unfortunately, the market is not favorable to you. So do you exit? See, here we have said that you can defer, as per your choice. It can be even deferred up to 70 years, that's the kind of a thing. And one can take annuity at even 75. You don't have to, take it even at 70. So now the question is, as I was mentioning, that people say, oh, my NPS corpus is giving good return. So why are you asking me to exit? Why don't I stay in the scheme and take the benefit of that? So keeping that in view, that we have brought in the systematic withdrawal plan, SWP, that in that process one can defer the annuity up to 75, and the 60% KT can be used as per your requirement on a fixed payments basis. You can say that I need a monthly payment, so it can be done on a monthly basis. You want it quarterly, half yearly, or annual, so this is what is to be done. So this is what we are going to enable, and I was told it should be done by October. So because this needed on the front end a lot of software changes and things like that, so that people can do seamlessly. That just with the click of a button, they make a choice that the 60% which is there, and so your money stays. It also grows, and you take out certain units out of that, depending on your requirement which is there. It is all, you can predefine that. So that is how it will work. Should happen in October.
This is a very exciting news for the investors. See, earlier there used to be always a talk. Look, if I've chosen 60 as my retirement age, what happens if the market has crashed when I'm 60? Then I will get the worst NAV. So now you have an option that if you are not happy with the NAV, you can defer your pension. So you can say, okay, I'll wait for another year or 2 years or maybe even 15 years. So you can take it up to the age of 75. And another great feature which systematic withdrawal is that, you choose to look out of I have built a 3 crore pension corpus, suppose. So 1.8 crores is where you can choose that, okay, on this 1.8 crores, I need an income of 1 lakh rupees per month because that's the kind of lifestyle, or I need 2 lakh rupees per month. Then you can simply choose to withdraw 2 lakh rupees a month. You don't need to go to any other instrument. And that 2 lakh rupees that you withdraw, your remaining amount of corpus will keep growing on every month basis. And as we had explained, sir explained, this is this is also new information for me, that debt funds here come with a guarantee that for non-performing assets. So I think this is one of the best places for you to buy debt or keep your money. So it is a very exciting thing, and we are very excited about October, sir. When these guidelines come out. Sir, also there's a lot of questions coming for Atal Pension Yojana. So what is the update on this and what is happening on that? If you can explain it to our viewers today.
See, Atal Pension Yojana is for deprived sections, people of small means. So one on retirement gets a pension in the range of 1,000 to 5,000 rupees per month, and so it is a defined contribution, defined benefit. Benefit is defined. That's what one gets, and accordingly the contribution is fixed. The other thing, it is fully guaranteed by the government, the pension scheme. So the numbers what we are seeing are mostly coming from Atal Pension Yojana. That if you see the last financial year, that we crossed a landmark of 1 point almost 1.2 crore subscriptions to the Atal Pension Yojana, and so far we have over 5.5 crore subscriber into the Atal Pension Yojana. And this financial year, 23-24, we have a modest target of adding another 1.3 crore subscribers.
Wow.
So the numbers are really coming there, and the benefit of that is that one gets a pension following one's demise. The spouse also gets the same amount of pension, and money also comes back. The accumulated corpus with the interest also comes back to the next of kin. So it is your saving scheme, medium to long term savings and pension rolled into one. So it's a very good scheme. Only restriction being that somebody who is a taxpayer should not go for this, because of the implicit government guarantee. But that doesn't prohibit those who file tax returns but don't but fall below the threshold, that they don't pay taxes. They can certainly go for this scheme. And the age restriction which is there is that it is that one can really choose between age of 18 to 40, between that age. So obviously those who are not eligible, suppose somebody is beyond 40, why not get it for your children, if they're of the age. So then one inculcates that habit. And premium also is very small, because one is joining young. So it's a very good scheme, and we are seeing good traction. But as you know, because this is a small ticket scheme, so the accumulated amount is less, and it is a guaranteed pension. And the return which the fund managers are generating for the APY is close to 9%, 8.9% return. So not only one gets the assured pension, I know the money also gets returned, assuming that the return stays on that level with whatever you have contributed to that particular scheme.
So, sir, there's also questions that how does one enroll for Atal Pension Yojana? Does it need to be done in a particular manner, or how does one join this scheme?
See, here it is simple through your bank. Many people just give on the it just onboarding takes half a minute. Many banks, because they are the POP, what we say, the point of presence. So it is in their net banking, and many have even enabled on the app, which is there. One can join, and the ecosystem is well managed, because you need to have a bank account, and you can also give an instruction of auto debit. So monthly, the amount gets debited from that side. It is as seamless as that. So it continues on that basis. And the other option is somebody wants to do one's own, that we have something called eAPY, which is done by the CRA, NSDL. So one can join through that process. If one doesn't like to go through the digital ecosystem, so there are agents, there are bank branches, one can walk in and they would enable in no time. So there are different ways. And we have also said the banks that they can also enroll people through their agents. The way we see the business correspondence, they also open account, do other banking facilities. They can also do the APY for them. So both the modes, physical mode and the digital mode, is available for doing that.
So for all the viewers today who are not who are less than 40 and they are not taxpayers, then Atal Pension Yojana is absolutely incredible from what we have heard about it. So please do join it, or if even if you're rich, then get your house staff and people who work for you and are with you to join it. I think it's an incredible opportunity. Sir, also there is a lot of questions on the withdrawal rules for NPS. So we have one of our viewers, Pandi Ramanathan, who's a very regular viewer, and we had earlier I had asked you a question from Mr. Anil Chopra. He's probably one of the most passionate lovers of your NPS scheme. So he was also asking a similar question that what are the partial withdrawal rules? And are they likely to change? Is there any relaxation they are expected in the future? What are the current rules? And what can people expect? Is anything in, works that is going to happen on that?
Sanjiv, here the issue is that it is a long-term corpus. Always one has a requirement and temptation.
And just clarifying, we are talking about tier 1 at the moment. So tier 2,
yes,
there is no. So we are talking about tier 1 pension at the moment.
No, absolutely. Tier 2, you put money today, tomorrow you can take it out. So absolutely no problem on that side. And since this is a pension corpus, so then the withdrawal is a little restrictive. We have kept it restrictive, but one can withdraw up to 25% of one's contribution from the NPS for certain purposes, which is quite flexible, medical and other aspects. And then it can be done 3 times during the cycle of that NPS. It is 25% of one's accumulation. The following that, if one wants to make it again, so then one can withdraw another 25% of the further accumulation which they have, their own contribution. Because the scheme where you are in the employer-employee kind of NPS, corporate NPS, so you cannot take out the contribution made by the corporate. So that will be there. Similarly, same thing happens if the government contribution, so that cannot be taken out. It's own contribution. So up to 25% of accumulation can be taken out, and it can be taken out 3 times.
3 times. So how many times
yes.
It is? So it is 25, 25, 25, or up to 25 3 times?
Up to 25. Up to 25.
Okay. So guys, so just for everybody's understanding, you can withdraw 25% of your corpus, and up to you get 3 chances to do it. So either you can do it 1 chance, you can withdraw 25, or if you have withdrawn 10%, then you have 2 more chances to withdraw another 15%. So that's a great, very great flexibility there. And also people are asking that what is the minimum age at which they can choose to start a pension? So is there a minimum age, or one can choose their retirement age as per their discretion? We have a viewer who's asking, can I choose 40 years as my retirement age?
No, see, one is kind of employer-employee relationship. Suppose in an employer-employee relationship, if the retirement age is, say, for example, 40, so one retires at 40. Got my point? So that is the thing. So it is not fixed on that basis. Standard, the way that you would see the normal employment, which is there, is about 60. So that is how it is. And but for example, all citizens model, then one comes in and joins, picks up NPS one's own contribution. So then it will be 60. But premature withdrawal is allowed after lock-in of only 5 years. The only restriction being after 5 years, anybody can go out. So there's no problem from that point of view. So in that case, one takes annuity for 80% of the corpus accumulated, and 20% you can draw cash, liquidity on that side. And the benefit of taking it at the end of the period, your 60-year or your retirement, given the employer-employee contract which is there, is that you have to annuitize only 40%, 60% you can withdraw as cash. So that is how it is. And somebody has exited the NPS, the other thing is there, can come back again. So there's no restriction in that. Suppose I don't like it as something, my situation becomes different. I go out after 5 years, and then I can come back 5 year one day again, can open a new NPS account. So that is also possible. So the other thing is that NPS is also portable. People keep changing their employer. So the PRAN number, what we call the NPS number, also stays the same. It can also be switched from one employer to the other. And people can go in and out of employment. They become a private person doing something of their own, though they were in corporate. So same NPS work. Then again, they get into a salaried employment, same NPS will work. So that portability is also there. And another thing that not that well known is that NRIs also. NRIs can also open NPS account. So people working here, like in a corporate, sometimes they worry that they also have to have a stint abroad. You stay more than 6 months, you become an NRI. What happens to my NPS? As an NRI, you can retain your NPS. So you come back, you become a resident. Some NPS also continues. So all this flexibility and portability there in the NPS scheme.
Yeah. And sir, as we were talking about SWP, so now monthly withdrawals, since like if a person decides to opt for SWP and he defers his pension, okay, so earlier there was this thing that, okay, you had 60% was tax-free. So same rules will remain for the systematic withdrawal also, that up to 60% of the corpus will remain tax-free in case he opts for an SWP?
Yeah, absolutely. That on the accumulation, because both are tax free. 40% what one would have to annuitize, and 60% what is accumulated. So that is both tax free. And another benefit which is here, even somebody is taking an annuity, so there is no, if you are taking annuity from NPS, so there is no GST on that. That is also tax free. Buying a normal annuity from the market or buying through the NPS route, NPS, you don't have to pay GST on that. So obviously the 60% accumulation is tax free, but then that amount will stay and expand, depending on your, the accruals into that in terms of interest, which is a return which is coming into that. Obviously, that would be at your income bracket. So
we have one of the viewers called Lalit, Mr. Lalit Banka. So he's asking this question that for NPS account to remain alive, a minimum contribution of rupees 500 per annum is required. What happens after retirement if the employer stops depositing and he needs to extend it to the age of 65, for example? Does he need to keep contributing, or he doesn't need to contribute after 60? Can he contribute if he wants to, or he cannot contribute once he's post 60?
No, because if it is employer-employee relationship within that, if it is a corporate NPS, after 61 can it becomes like an all citizens model, because it becomes a private NPS. So it is pretty much left to you, Mr. Bansal, that whatever you want to do on that basis. Of course, as you rightly observe, to keep that account active, that you have to monthly contribution 500 that you would have to make. So even if you have not made that 500 contribution, that accumulated corpus is also growing and giving you a return. And suppose there is for some reason, maybe for negligence, that you didn't make it active a particular year, subsequently when you make a contribution, that again it becomes active. So money is not going away, money is accumulating, and it makes sense to just threshold is so small, just put 500 and so that the in a year's time, it is not one would have to put in a monthly basis, not that. So as flexible as that. So the bottom line is that you can certainly continue as long as you want up to the age 70. So no issue from that point of view.
Yeah. So, and just as we had explained, and sir, if you can clarify if my understanding is correct or not, that the tier 1 pension account is your tier 1 pension account. So the corporate is contributing into the same account, and you can also contribute into the same account. So up to 50,000 rupees, if you put from your own funds, goes into the same account, and you get a tax benefit under that. So a lot of people think that the corporate NPS goes into a separate money, and the individual contribution goes into a separate corpus. Sir, if you can explain that.
No, absolutely. For example, the 10%. See, normally the way it works that 20% contribution comes for a superannuation fund. The corporate contributes 10%, and the individual contributes 10%. So that's the standard, the way it comes. Both are tax free. The 10%, the corporate contribution to my NPS is tax free, and this 10% that my contribution under the ATC gets tax free. That apart, Sanjiv, as you rightly observed, so if one is in under the old tax regime, the NPS has a privileged tax benefit of additional, 50,000 rupees. So apart from the 10% each, suppose somebody has put money, say 1 lakh. So out of that 50,000, you get additional, tax break on that side. Of course, the 50,000 would be taxed on your your rate, unless it is coming under ATC. Still, there is unfilled gap under ATC. Still, you can claim that additional personal contribution into the NPS. Your understanding is absolutely right, sir.
So we have a very unique question. That is that can an HUF and a trust, discretionary trust invest in pension NPS?
So it is, it is individuals. So that is as things stand now, unless the employer-employee kind of a thing, which is there. So,
Yeah, so I'm quite amazed by the unique questions we are getting. So there's a young viewer Ayushi who's asking this question. It's already been answered, Ayushi, but it's an important question. That how does PFRDA ensure the safety and security of pension funds interested in various schemes? So as Sir had already answered this question, but since this is very important and a lot of people are asking this question over and over again, let me just repeat what Sir had said. And Sir, if you can add in if I've missed something here. So point is that, so what PFRDA does is that they are regulated pension fund managers. These are large financial institutions who have to take a license for being pension fund managers. And today in a pension equity scheme, only top 200 equities are allowed. So these are basically, let me say, like large cap funds that you're choosing. So that is one aim of the security. Second is that in case of debt, it needs to be a AA and a AAA rated security. And in case there is a default, then the pension fund manager has to provide for that default. So that there's a lot of safety available here. It is probably, amongst all the instruments I've seen, this is probably one of the safest one. Sir, would you like to add anything here?
Yeah, because if you go by the instrument characteristics, that if you see investment as we speak now, I just mentioned about 10 lakh crore that we have invested. So out of that, equity is about 18%, which is there. So 1 point around that, of course, it fluctuates with the market. 8 lakh, as you rightly observed, these are in the top companies which is invested. And then the 66% of the corpus is in the government securities. Obviously, they are completely risk free. Balance in corporate bonds, and as you rightly observed, these are highly rated paper, and default happens in a very rare cases. We know a few high profile cases, so it just happened because it normally doesn't happen on that basis. If it were to happen on that basis, they have to be fully provided for, irrespective of the consequences, irrespective of the process dragging on for long. They would have to really provide for it. There is no hidden loss should be there in the system. But given that the net asset value also fluctuates in the market, depending on the market performance, depending on the interest rate movement. And since this is a long-term investment, that if we ride a couple of market cycles, I think I would believe the equity cycle would be like 5 to 6 years. So if you have the staying power of staying about 12 years or so, you are covered in that sense. That is how they are quoting that if you see the long, since inception kind of a returns, despite annual fluctuations and all that, these are pretty good returns. For example, equity is 12.6% as we speak, and the most safest instrument, I'm saying 100% GSEC is 8.7% return. So these are kind of return you have earned in the system. So safety is paramount, because we do realize these are the pension corpus. It has to manage a little more conservatively. Though equity gives a better return, but still we have the guardrails to see that things go fine.
Yeah, sir, one last question we'll take. I know we are almost over time, but this is again a beautiful question. They said, and this is like, see, for Bajaj Capital, NPS is one of the most favorite schemes. And although the earnings are very minimal to nil, but still we want all our clients to have it. And, they can buy it through our website. And we have tried to make the tools available where people can see their balances anytime. But the question that people ask is that, look, that due to the low commission, the availability of this product, although it's available at the bank, but it's and other places, but it's very difficult to get, and nobody creates awareness about this. So our couple of our viewers are asking this question. So why hasn't PFRDA looked at making this compulsory for all companies to be part of the corporate NPS and offer it as an option to their employees? Because they are saying that a lot of our companies, we have to go argue and they refuse to join this. So why shouldn't it be compulsory for all the companies to join this scheme, and then employees can volunteer if they want to be a part of it or not?
Sanjiv, first of all, let me appreciate, despite the low commission, that you are promoting this product, and many of you are doing that, seeing the benefit. And the beauty of this product is that the commission is low, because the low cost product. So the benefit is passed on to the investors. And the other question is very important, because corporates, we have many. Of course, some corporates have not come in, not joined, but we have many, about 13,400 corporates have joined NPS actually. But the take-up rate by the employees is less, because the corporates have not made it compulsory. They have made it optional, because it is neutral. If the corporate contributes to your post retirement kitty through the provident fund or through NPS, they get the same tax break. The investor gets the same tax break. The corporate also gets the same tax break their contribution. So they have not made it compulsory. And partly it is again lack of awareness as we speak. And so you are right, because maybe if the commission would have been a little more, maybe people would have campaigned more on the awareness side, push this product. But having said that, we have made it fully digital. If you are aware of the product, oneself can just open the account. It is the eNPS account that one just types eNPS and goes and logs in. It takes about 20 minutes. KYC also gets done and all that. So no intermediary is involved. And the whole thing is on your fingertips. So that enablement we have done. But I agree with you, because we need to expand awareness. And the session like this, I think it also helps spread that kind of an awareness. And what we are doing now, that we are also planning to engage with corporates directly through all these trade bodies, that with their HR, giving this knowledge and nudging them that they should really give NPS. And compulsory again, because in many places like in UK, that they have a opt-out option, because automatically it is given, your pension account is given, but you can opt out. That freedom is given. But then opting out becomes very 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 less in that sense. But given the nature of labor market here, because mostly people are professional, self-employed, so they would have to do it on their own. So making it compulsory also becomes difficult. And the choice between the provident fund and the pension, that to be necessarily compulsorily, you have to be on the provident fund if you have a monthly salary of 15,000 or less. But in the corporate, everybody gets, I would believe, more than 15,000 a month. So that Statutory compulsion is not that, but the choice is given, and people should utilize that choice.
Yeah, so there are a lot of requests that please make it compulsory and let people opt out, because I guess a lot of people must be facing this pain where the company refuses to uh, join this scheme. Sir, also there one final question. I know we are very over time. Is that this 7.5 lakh rupees, at least for the HNIs, EPF and the NPS limit, sir, is there any chance of PFRDA championing to get any relaxation from CBDT on this?
Sanjiv, that remains completely with the domain of the government. Government has its own consideration. So I would, refrain from commenting on that. so,
Yeah.
so
But sir, thank you for joining us today. It was a truly insightful session, and I think anybody who watches this is going to be truly a richer person and truly a more prosperous person. One of our viewers had asked me this question: that is PFRDA and NPS the only retirement scheme? No, you can save money in many ways, but it is probably the best scheme that you must have as a part of your portfolio. And also, I'd like to tell all the investors that please have a consolidated view of all your money. A lot of people do a lot of investments, but in India, there's a huge problem of unclaimed funds because they don't tell their family. Nobody knows, where they have invested, or they even forget. So keep all your money in one consolidated place. And sir, any last words for our viewers today from you? And thank you for an amazing, amazing session.
no, thank you, Sanjeev. As you rightly pointed out, that if you see that entire retirement corpus, roughly if you estimate, including EPFO, including the insurance company, that and including NPS, so this is in India is about 16.2% of GDP. And if you look at the advanced country, the OECD countries, the average is like 90% of GDP. Certain countries have close to 200% of GDP as pension corpus. So obviously it suggests there is a long way to go, and this is a corpus which is bound to grow. So that doesn't mean those people, they are only putting money in pension. So through that diversification, because our people also save, different saving media is there. We are doing in physical assets, we are doing in houses, but reallocation towards pension, there is a need, and also desirable. So that is what I would mention. And finally, we are also open. Anybody can get in touch with us. So we'll be more than happy to assist them. And we can also handhold with the corporates and extend whatever support that we would have to provide. So we are certainly happy to do that. So thank you, Sanjeev, for your time and having me on your show. It's been great experience. Thank you.
Thank you, sir, for taking time for us and our viewers. Thank you. Thanks a lot.
Thank you.